In section 11-3, we're going to be talking about something called retained earnings and dividends, and also what our transactions look like for those two things. So anytime we are talking about dividends and retained earnings, that has to do with a corporation. Corporations that are publicly traded, meaning you could buy a stock on the New York Stock Exchange for that company. So any company that is publicly traded has to have something called a board of directors, and that is a group of people that govern or make decisions for a company. So those people are not associated with the company at all. They don't work for the company. They're the board of directors that guide the company, and they don't have any incentive to make decisions that benefit themselves. So they're outside people from the company. One of those decisions that the board of directors makes is whether to declare a dividend. So a dividend is, think of it like a bonus given to stockholders. So if a company has a really good quarter, they make $1 million extra, let's say, the board of directors could decide, let's declare a dividend and give each stockholder a bonus because we had a good quarter. So they give the dividend, the bonus, to the stockholders. And the reasons they might do this is so that then stockholders, they might use that money, use their bonus to buy more stocks in the company. They might use that bonus to just think of it as, wow, this company shows good loyalty and we're going to hold on to our stocks. So there's an advantage to paying dividends. The other option is that the board of directors might decide, let's just hold on to that $1 million. And that is when the company keeps the money. It's called retained earnings. And you can see here on this slide that companies can make the choice to distribute those earnings in the form of dividends or reinvest in their company, which is retained earnings, and potentially make more money. So that $1 million can either be divided out to stockholders in the form of dividends, or they can hold on to that money, maybe use it for marketing to sell more of their item, or maybe they use that money to create a new product and make more money for the company. So either way, it should result in a benefit for the company, and just kind of a matter of what the company prefers to do. Some companies are just notorious for always paying dividends, and that some people like to invest in companies that they get that dividend money. Others prefer to reinvest that money in their company. What we need to look at is what happens when a company declares a dividend and what the accounting looks like for that. So we have a few extra accounts, new accounts that we haven't used before, most notably 3140 there, the dividends account. So declaring a dividend, let's say that our board of directors declared a dividend. So we made extra money. We decided we're going to give a bonus to our stockholders, 5 cents per share. So if you owned 10 shares, you'd be getting 50 cents coming your way. So not a ton, but if you owned several shares, it would add up over time. Well, we have 75,000 shares outstanding. So that might mean that we have 75,000 different people owning 1 share, or we might have 25,000 people owning 3 shares each. So it doesn't matter who owns what, but every share is worth 5 cents. So 75,000 times 5 cents, we are going to in total have to pay out $3,750 in bonuses. So that transaction looks like this: a debit to dividends and a credit to dividends payable to increase the amount that we owe to our shareholders. So we'll use our general journal, debit our dividends account, it's a memo 43, and then credit our dividends payable. So that is our transaction. That's saying we are going to set aside this money and pay it to our shareholders. Our next transaction we need to do is when we actually write that check. So we paid cash for the dividend. So it looks like you could see here in our dividends payable T-chart, every 3 months we've been doing this. So December, all the way back a year, we've been paying out dividends. And then our cash is decreasing. So we have the date, dividends payable, check 742. Notice in the cash payments journal, it's always a check, so we don't need to write C. We're debiting dividends payable to decrease that amount, and then we're crediting cash. So anytime we're in the cash payments journal, we're always going to have a number in the cash credit column. And in this situation, we're debiting dividends payable to decrease that liability. So that is what the transactions look like when a company decides to pay dividends or bonuses to their stockholders. We first declare dividends, do our transactions in the general journal, and then later we do the payment in our cash payments journal.